Imagine waking up on a still summer morning, brewing a strong cup of coffee, and opening the news, only to be confronted with a headline that over $800 billion worth of Chinese assets are suddenly at risk of being frozen. Pause for a moment and consider the gravity of that sum. More than the annual economic output of the vast majority of countries on Earth, enough to fund the entire NASA mission portfolio for decades, more than sufficient to build thousands of new hospitals or universities, and certainly enough to send tremors through every corner of the global financial system. But here's the twist. This isn't a story about a small, isolated nation facing sanctions. This is a direct confrontation between the world's two undeniable economic titans, the United States and China. What happens when financial firepower becomes a geopolitical weapon, and one of the world's largest economies responds not with outrage, but with an abrupt, unsettling silence? Today we dive into the invisible chess match that could upend the future of global finance, and why this silent standoff could impact every one of us, no matter where we live, what we do, or which currency we use. Let's rewind for a moment to understand how we arrived at this extraordinary crossroads. For more than 4 decades, stretching back to the pivotal year of 1979, when China first began opening its doors to the world, the United States and China have maintained a relationship best described as a delicate dance of both cooperation and competition. At first, trade between the two countries was a trickle, but as China's economic reforms accelerated, this grew into a flood of commerce. American companies rushed to China, lured by cheap labor, vast new markets, and a seemingly endless appetite for U.S. products. Meanwhile, China's factories powered the world, exporting everything from electronics to clothing and racking up enormous trade surpluses. But the relationship extended far beyond the exchange of goods. Over years, China accumulated a staggering pool of reserves, vast stockpiles of U.S. dollars, eventually purchasing more than $800 billion in U.S. Treasury securities. At its peak, China was the largest foreign holder of U.S. government debt, a position that wove the financial destinies of both countries together in a way that seemed unbreakable. For a time, this symbiosis worked. The United States could finance its deficits, while China enjoyed economic growth that lifted hundreds of millions out of poverty. Yet this interdependence brought with it hidden risks. The global financial crisis of 2008 laid bare some uncomfortable truths. As economies crashed and markets teetered, American policymakers began accusing China of artificially depressing its currency, the renminbi, to supercharge exports and undercut foreign competitors. The Obama administration responded with new measures designed to level the playing field, but the underlying tension never disappeared. Instead, it smoldered, flaring up again during President Trump's first term. The rhetoric escalated, with tariffs slapped on hundreds of billions of dollars worth of goods, and angry headlines about intellectual property theft, forced technology transfer, and the threat of a full-scale economic decoupling. Even after the so-called Phase 1 trade deal in 2020, which provided a temporary truce, the deeper fissures in the relationship remained unresolved. Fast forward to the summer of 2025. On July 5th, President Donald Trump, having returned to the White House, signed into law a sweeping legislative package, triumphantly named the Big and Beautiful Bill. While this bill did not immediately freeze Chinese assets, it granted the U.S. Treasury an extraordinary new arsenal of powers. If China was ever designated a national security threat, or if tensions over flashpoints like Taiwan exploded, the Treasury would be authorized to seize or freeze Chinese assets held within the United States. Alongside this, 2 more groundbreaking bills were passed: the Chinese Currency Accountability Act and the China Financial Threat Mitigation Act. These laws mandated regular stress tests for U.S. banks, imposed new penalties for currency manipulation, and ordered contingency planning for the possibility of a sudden rupture in economic ties. The message from Washington was clear. Gone were the days of business as usual. The fate of over $800 billion of Chinese reserves now hung in the balance, a sum representing not just financial muscle, but the very architecture underpinning decades of global stability. The world collectively held its breath, waiting for Beijing's response. Would the Chinese government unleash a barrage of fiery editorials in the state-run press? Would the Ministry of Foreign Affairs deliver a stern, public condemnation? Would the People's Bank of China call an emergency meeting? Instead, something even more disquieting happened. Nothing. Absolute, deafening silence. Not a single official statement. Not even a vague hint of protest. For a government renowned for rapid-fire, forceful rebuttals to any perceived foreign insult, this silence was almost shocking. But do not be fooled. China's silence is not a sign of confusion or weakness. It is a deliberate, meticulously calculated strategy, as Alicia Garcia Herrero, chief economist at Natixis, explains. China's silence reflects a long-term strategy to de-dollarize and build an alternative financial infrastructure. George Magnus, senior economist at Oxford Economics, warns. Financial sanctions against China could trigger a severe global recession and disrupt supply chains. Why would Beijing choose such a muted response in the face of a threat that could endanger its vast national wealth? The answer lies in a complex web of political calculation, economic priorities, and an astute reading of American politics. On one level, China's leaders are all too aware that an angry outburst would play directly into President Trump's narrative. The Trump administration has consistently portrayed China as a direct threat to American interests, economically, technologically, and geopolitically. Any loud protest from Beijing could serve as perfect justification for further escalation, whether in the form of more sanctions, deeper economic decoupling, or even the outright freezing of Chinese assets. The stakes are even higher within China itself. Publicly admitting that China's enormous US dollar reserves are now a vulnerability could trigger panic among investors, leading to massive capital flight and a sharp depreciation of the renminbi. With youth unemployment at record highs, local governments struggling under piles of debt, and the property sector still reeling from years of overbuilding, the last thing China's leaders want is to fuel a crisis of confidence. In this context, silence acts as a shield, protecting domestic stability, preserving market calm, and buying precious time to quietly recalibrate strategies. But make no mistake, behind the scenes, Beijing is anything but idle. In August of 2025, for example, the People's Bank of China quietly injected $20 billion into the domestic money markets. This was not just a technical move. It was an unmistakable signal to financial institutions that the central bank stood ready to defend liquidity and stability. In parallel, cross-border settlements using the renminbi soared to an unprecedented $3 trillion in the second quarter of the year. This surge is part of China's broader drive to internationalize its currency and reduce its dependence on the greenback. Meanwhile, China's gold reserves jumped by 15 tons in July, reaching record highs, while holdings of U.S. Treasuries dropped to a 15-year low of roughly $750 billion. The message is clear. China is diversifying, hedging, and quietly reducing its exposure to dollar-based risk. And China's innovation does not stop there. The People's Bank of China has begun live tests of the digital yuan for cross-border payments with several Southeast Asian countries, marking a significant step toward building a future in which Chinese financial infrastructure could sidestep American-controlled networks entirely. These quiet but determined efforts are laying the foundation for a parallel global financial system, one that could endure or even bypass U.S. pressure. To truly comprehend the scale of what's unfolding, consider the intricate architecture of the world's financial plumbing. For decades, the US dollar has acted as the linchpin of global commerce, serving as the dominant reserve currency and the backbone of the SWIFT international payment system. This has granted Washington unparalleled power, not only to finance its own deficits cheaply, but also to impose sanctions on adversaries and shape the rules of the game. Historically, the United States has wielded this power against smaller economies, from Iran to Venezuela to Russia. But applying these tools to China, the world's second-largest economy and a critical node in global supply chains, raises the stakes to an entirely new level. Let's widen our lens and look at the silent tactics Beijing is deploying. First, China is engaging in what experts call silent diplomacy, quietly reaching out to countries in the global south and Europe that may share concerns about the weaponization of the dollar. By positioning itself as a more reliable and less unpredictable partner, China is seeking to build coalitions and limit its isolation. Second, by not reacting publicly, China avoids providing ammunition for further U.S. escalation, instead focusing on behind-the-scenes containment. Third, Beijing is controlling the domestic narrative, carefully curating economic messaging and avoiding any acknowledgement of vulnerability, which could undermine public trust in the government's competence and control. This approach is not without precedent. In previous crises, such as the Asian financial crisis of the late 1990s, China maintained a steady hand, keeping its currency stable and projecting an image of calm, even as its neighbors' economies crumbled. Today, faced with a vastly more complex and globally interconnected challenge, China is once again relying on a strategy of discipline, caution, and incremental adaptation. But what are the possible outcomes of this high-stakes standoff? Let's explore a few scenarios that experts are debating right now. First, there is the risk of a true financial Cold War. If the United States follows through on the threat to freeze Chinese assets or imposes sweeping sanctions, the world could witness the emergence of rival financial blocs. Sanctions, asset seizures, and technology bans would become commonplace, not rare exceptions. Supply chains would fracture, global trade would slow, and the dollar's dominance would face its first genuine challenge in generations. As Mark Sobel of the Center for Strategic and International Studies warns, the risk of financial decoupling is real, and it could destabilize global markets and reduce the dollar's influence. Already, countries from Russia to Brazil to South Africa are quietly exploring alternatives: regional payment systems, digital currencies, and gold-backed trade agreements. A second scenario is what analysts refer to as managed decoupling. In this world, the United States and China agree, formally or informally, to unwind their financial interdependence in sensitive sectors, while seeking to keep the machinery of global commerce humming. This would involve stricter controls on cross-border investment, tighter barriers to technology transfer, and a move away from the hyper-efficient, low-cost supply chains that have defined globalization for the past 3 decades. The consequences would be felt by businesses and families alike: higher prices for consumer goods, increased borrowing costs, and fewer product choices on store shelves. The world would become more fragmented, less efficient, but perhaps better insulated from future shocks. Yet there is also a third possibility: a so-called new equilibrium. Leading economists such as David Dollar believe that a complete financial decoupling remains unlikely, given the sheer scale of mutual interests. Instead, they foresee a world of increasing fragmentation, a patchwork of competing blocs, overlapping alliances, and selective cooperation. In this scenario, both giants accept that outright victory is impossible. Instead, they settle into a tense but manageable coexistence, cooperating where it is essential, on issues like climate change, pandemics, or technological innovation, while competing fiercely elsewhere. This would require deft diplomacy, a willingness to compromise, and a recognition that the world's biggest challenges demand at least some degree of partnership. To grasp the magnitude of what's at stake, it is instructive to look back at the Cold War era. The rivalry between the United States and the Soviet Union was intense, but their economies were largely separate. Today, the US-China standoff is far more precarious, precisely because the two economies are so deeply intertwined. A sudden rupture would not only disrupt trade and investment, it could trigger a global recession, send shockwaves through emerging markets, and undermine the dollar's status as the world's reserve currency. Michael Pettis of the Carnegie Endowment observes, the U.S. legislation may accelerate China's efforts to reduce its reliance on the dollar and develop its own financial system. The numbers are staggering. According to a July 2025 report by the Rhodium Group, foreign direct investment by U.S. firms in China has already dropped by 20% year-on-year, reflecting growing anxiety about financial weaponization. The China Financial Threat Mitigation Act now requires U.S. banks to conduct regular stress tests, preparing for a scenario in which hundreds of billions of dollars in Chinese assets could be frozen overnight. Meanwhile, China's gold reserves have surged, the renminbi is being used in record volumes for cross-border settlements, and the digital yuan is being piloted throughout Southeast Asia. The tectonic plates of global finance are shifting beneath our feet. At the heart of this transformation lies the question of trust. The global economy runs on confidence. Confidence that contracts will be honored, that currencies will retain their value, and that the rules of the game will not change overnight. When major powers threaten to weaponize the very infrastructure of global finance, that trust begins to erode. As Eswar Prasad of Brookings warns, weaponizing the dollar could undermine its global dominance, prompting other nations to seek alternatives. In other words, the more the dollar is used as a tool of coercion, the more incentive others have to find ways around it. So what does all this mean for you? The truth is that these high-level chess moves ripple out to affect our daily lives in unexpected ways. If global uncertainty pushes up interest rates, your mortgage or business loan could become more expensive. If supply chains falter, the cost of smartphones, cars, or groceries could rise, sometimes overnight. If the dollar's dominance weakens, the value of your savings or retirement funds could fluctuate in ways that are hard to predict. Faced with this new era of uncertainty, what can ordinary people do to protect themselves? First, stay informed. Don't just skim the headlines. try to understand the underlying dynamics and motivations behind the news. Second, diversify your savings and investments. Don't put all your eggs in one basket or one currency. Consider a blend of assets and be open to opportunities in emerging markets or innovative technologies. Third, embrace adaptability. The world is changing rapidly, and flexibility is now one of the most valuable skills you can possess. As Eswar Prasad warns, the old certainties are gone, and flexibility is your best ally. There are lessons here for leaders and policymakers as well. The temptation to weaponize financial power is strong, especially when national security or political advantage is at stake. But history teaches us that such moves can have serious unintended consequences, damaging trust, undermining alliances, and ultimately weakening the very system they seek to protect. The global financial system is complex and fragile. Every action triggers a reaction, and the law of unintended consequences is never far behind. As we approach the finale, let's return to our opening question. Is China's silence a sign of surrender, or the opening move of a new, more subtle strategy? For now, Beijing's silence is not a retreat. It is a calculated pause, a way to buy time, forge new alliances, and quietly build alternatives to the dollar. At the same time, Washington is signaling that the old rules no longer apply, and that it is willing to accept new risks to defend its perceived interests. The world stands at a crossroads, with a new era of competition and caution already underway. Here's the little-known truth. Even as the world obsesses over confrontation, both sides are investing heavily in resilience. China is stockpiling gold, launching digital currencies, and reaching out to partners in Southeast Asia, Africa, and the Middle East. The United States is modernizing its financial regulations, deepening alliances with Europe and the Indo-Pacific, and stress-testing its own economic vulnerabilities. The real battle is being fought not only in public statements or legislative chambers, but in the invisible networks of global finance, the flows of capital, the architecture of payment systems, and the fragile trust that holds it all together. So what happens next? The answer depends not only on presidents and policymakers, but on each of us, how we adapt, how we prepare, and how we remain curious about the world's shifting tides. In an era where silence can be as powerful as words, and where financial strength can be both a shield and a sword, it pays to stay agile, informed, and open-minded. If you found this deep dive valuable, don't forget to subscribe, share your thoughts in the comments, and stay tuned for our next episode. We'll be exploring how digital currencies are reshaping the balance of power across the globe, from the rise of the digital yuan to the evolving challenges facing the euro and the new frontiers of financial technology. Until then, keep your mind open, keep your eyes on the markets, and remember, the next